the surplus which is to be computed on a trade in virtual digital asset has been very briefly stated, the manner in which it will be computed in section 115 BBH. It says that the surplus will be carried out, will be worked out only by reducing one item, which is the cost of acquisition, right? And here cost of acquisition is a bare cost of acquisition at this point in time, right? Whether you can load anything more over the cost of acquisition, right? That is not provided, right? I will be trading cautiously on this area had I been an investor, not to load any amount other than the bare cost of acquisition.
All right. Okay. That's a very clear indication from you. The second area, sir, where clarity is required is the set-off provision. Now, it's clear that the set-off can't work inter-assets. So, for the benefit of our viewers, you can't set off crypto gains against, for instance, losses in mutual funds or shares. But what's not clear is, will the set-off work within the universe of VDAs or virtual digital assets? So by way of an illustration, can I set off loss on Bitcoin against gain in Bitcoin, or loss in Bitcoin against gain in NFTs, and assuming all of this is in the same financial year and nothing is being carried forward?
Okay, let me answer it in this manner. First, what is clear in the legislation is that loss emerging out of the chapter 12, that is the special provision in 115 BBH, it cannot be set off against any other head of income, meaning thereby it can't be set off against capital gains, can't be set off against house property income, can't be set off against income from business, can't be set off from income from other sources or salary or anything, right? That's very clear. All of the trading in the virtual asset, digital asset, are grouped together all in one through section 247 capital A, 115 BBH. They're grouped together, right? So if you make a particular stream of trading in a particular currency, then you have a profit, and in the other currency you have a loss. You want to set them both off, right? Under chapter 12. If you want a guidance on that one, clarity, guidance on that one, I can provide that. But what is clear at this, I'll provide that on a later date, right? Once we start, because this is an issue which has not emerged just from this discussion, but it is emerging since the day the legislation has been announced, right? I will not be erring. Sorry, I will be erring if I preempt the answer and give something off the cuff right now, right? I am not going to commit on that, okay? But the point is well taken, that within that chapter 12 special provision in 115 BBH, if in one variety of currency you have a profit and in the other variety you have a loss, whether they can be set up, right? This is a very valid argument. I agree to the question which has been raised, but for an answer, give us a day or two in which we will come very clear on this one, right?
How will TDS work when you're executing trades on an exchange? Who will deduct TDS here? Because as I understand, not in all cases, the buyer or the seller at the other end or the party at the other end. Who will deposit this TDS with the government? Similar issues will occur if an Indian resident is executing the trade on an international exchange or a decentralized exchange.
The larger intent of the new provision 194S is to map the whole universe of the digital asset trade, virtual asset trade in the country, the investment and the trade. And this has been the traditional and the easiest way in which we can track the investments made, profits generated, or losses incurred in this kind of trading, right? So that's why 194S is being kicked in. And in the 194S, you have the liability to make TDS at the time of payment, right? Not at the time of receipt. So who will be making the payment? Payment will be made by the purchaser, right? Payment will be made by the purchaser. So onus is on him at the time of the purchase, as I understand at this point in time. And there are exclusions also in 194S, which will not require a TDS, right? In the case of specified persons, it is 50,000 in a year. If you do trading of 50,000 in a year, you escape, right? But you have to be a specified person. And specified person has been defined as an individual or a HUF who is not doing business in excess of 1 crore per annum in the one previous to the relevant assessment year. And in the case of professionals, he should not be doing professional receipt. He should not be getting professional receipts in excess of 50 lakhs, right? These two specified persons, classes of persons, they escape having the TDS obligations only if their turnover from the virtual trade is not in excess of 50,000. In the rest of the cases, it is 10,000, flat 10,000, right? Beyond 10,000 of crypto trade, they have to deduct the TDS under 194S, right? And 194S also will not apply for the specified persons alongside 203A and 206AB, meaning thereby they don't have to have a TAN, they don't have to have a TAN in order to remit that amount. And they also will not be saddled with that double taxation, double the rate of taxation under 206AB. So they escape that one. So TDS provisions may be read through a little more carefully, also by us also, and we'll hear all voices before we make up our mind as to how efficiently and how easily this can be worked out on the field.
Sure, but would you account for, when you frame guidelines on this, account for the commercial reality of how these trades work, that not in all cases, you would know the party at the other end? Would the final sort of framework account for this commercial reality, sir?
That's why income tax is getting into the whole, in the business of, the virtual asset class, because there's a lot of opacity. You don't know the counterparty, right? I know that there will be teething problems, but the point is, if you make investment either directly or through P2P, right? Through the exchange or in P2P situations, right? If you're doing it through the exchange, there's no problem. You should be knowing the exchange, right? When it comes to P2P, which is also a sizable sector, so we'll be doing P2P. It's essential that you know the counterparty, right? If it is routed through the exchange, there is every reason as to why you would not be knowing the counterparty who has placed the purchase order against your sell orders. That will not be knowing, and justifiably so. But in a P2P situations, if you are knowing the counterparty, right, then there is a problem. Can't let the opacity hang around this business for a long time.
When it happens through exchanges, let's say domestic Indian exchanges, will it be the onus be on the exchange to deposit this TDS?
At the time of payment, it is stated. So can't hear.
I'll repeat myself, sir. Am I audible now?
Yeah.
My question is that in the case of exchanges, Indian exchanges, will the onus of deducting and paying this TDS be on the exchanges from April 1st?
See, I am told, and this has been reported, that exchanges in crypto work in a manner which is different from the normal stock exchanges, right? Here, the exchanges, they create the market. They are the market. They are also market participants also, right? They take positions counter to the investor in many cases, or in most of the cases, in some exchanges, right? A purchase order of a customer may be directly dealt with by the exchange itself, right? Through its own stock. So these are the situations. Point is, if that is happening, then whoever is to pay will have to deduct that 1%. If the exchange bears that responsibility, then it has to deduct the tax, right? TDS. So the point, what I'm trying to convey to you, that 194C situation should be applying, the provisions should be applying in all cases of transaction, whether you are doing P2P or through the exchange.